Good afternoon, everyone, and welcome to the results call for Q1 FY2021. We also have with us Mr. Bharat Sheth, Deputy Chairman and Managing Director, who will take part in the Q&A later, and he'll probably make a short statement after I finish with the presentation. So let's start with the presentation now. First of all, we'll have some forward-looking statements here, and our market is extremely volatile. It changes within a couple of weeks from boom to bust and bust to boom. So you have to take all our statements in light of that. Coming to the financial results for first quarter of FY 2021, we had an extremely profitable quarter. In fact, the most profitable quarter since the September 2008 quarter, which was just before the start of the global financial crisis. This quarter was, of course, helped by huge turmoil around the pandemic, and which resulted in tanker rates spiking to levels not seen before, at least not in the last 20 years, and therefore very strong earnings on the tankers. So let's go forward. You've seen these reported results. We reported a profit on a standalone basis of 465 crores for the quarter and 468 crores on a consolidated basis. Last year, we reported a loss in the same quarter of the first quarter of the previous financial year, both on a standalone and a consolidated basis. In the past, we've spoken about how these results may not necessarily are getting affected by a lot of extraneous factors, which we need to strip out to see the real impact of the operational performance. In fact, our chairman also referred to it in his statement in the annual report. So let's just go forward and look at that. So what we are going to discuss are normalized financial results, and this is what we have done to normalize. You know that we have to revalue our foreign currency loans and the current assets and liabilities as at the end of each quarter. That impact has been removed from the results, whether it's a positive or a negative. The second impact that we've removed is on the NCD currency swaps. We have raised a large amount of funds through issue of non-convertible debentures, which are issued in rupees in India. However, since we want to have dollar debt to match our dollar assets, we have swapped those liabilities into US dollars by using foreign currency swaps, and therefore we've created synthetic US dollar fixed rate loans. The mark-to-market change of these derivatives affects the reported numbers, and we think that those are extraneous and should be taken out. Therefore, when we calculate the normalized numbers, it's after making the necessary adjustments to the reported numbers to reflect the effective cost of the synthetic US dollar loans. I realize that this is a little complicated, but we can discuss this separately in case anyone wants to have more detail on this. And I suggest we don't take it up an explanation on this call. So here are our normalized financial highlights. We discussed that we have 465 crore reported profit for Q1 FY21. If we remove the effect of those two items, we come down to 422 crores for what we call the normalized net profit. Again, this is not a GAAP number. It is not as per any accounting standard. This is what we believe correctly reflects after taking out the impact of the foreign currency movement and the derivatives movement. For the same quarter in the previous year, we moved from having a loss of around 50 crores to having a small profit of 17 crores on a standalone basis, similar on a consolidated basis as well. So now let's go forward to what the ratios look like based on this. But before moving forward, the important thing to see is cash flow. How have the cash flows been? And it's an important thing in our business because accounting standards are what they are, and the truth comes in the cash flows. You'll see that we had very strong cash flows. Even in the quarter when we declared a loss, that is Q1 FY20, we had a nearly 200 crore net cash inflow. In this quarter, we've had a net cash inflow in excess of 500 crores. Looking at the ratios, we had on a standalone basis, again, this was a spectacular quarter in terms of the tanker rates. As I said, some of the rates we saw have not been seen before, at least in the last 20 years. And therefore, we had a 30% return on equity and a 20% return on capital employed. So leaving aside the return ratios, which is just an annualizing of the first quarter's profit, what's happened is that we've actually been able to deleverage significantly between last year and this year. You can see that in the net debt to equity number. We were at 0.45 and we're down to about 0.24. And we'll discuss this in a little more detail later on in the presentation. The other data point that we look at every quarter is the net asset value per share. So we are at around 456 rupees per share net asset value on a standalone basis. And on a consolidated basis, we are between 494 and 536 rupees per share. Again, those of you who have been following us for some time know that this range given is because it's not very easy to put a number on the offshore asset values because they are not as liquid as shipping. So we get a range of valuations from the brokers when we take a value. This 456 rupees NAV was 454 rupees as of March. We had very strong cash flows during the quarter, however, which added to the NAVs. However, we had a drop in the values of ships between March end and June end of about 7%, which compensated for each other. Of course, we also paid out the second interim dividend of 2.7 rupees per share during the quarter. So looking at over the past 1 year, we started at 383. We paid out 2 dividends totaling to 8 rupees, and the NAV improved from 383 to 456, which is about a 20% return on the NAV in the last 1 year. Looking at the performance, and the number of days did not change too much, so there's nothing much there. What did change is the TCYs earned between Q1 FY21 and Q1 FY20. You can see that the crude tankers earned on average less than $15,000 a day in Q1 FY20, and as against that, we earned $40,000 a day in Q1 FY21. This was even stronger than Q4 FY20, which is also an extremely strong quarter. So the product tankers went from earning $14,500 last year to $18,000 in Q4 to $27,000 on average in Q1 FY21. And also the LPG carriers. The LPG carriers are mainly predominantly on time charter. There's a very small spot fixture in between, but otherwise these are all time charter, earnings on time charters. Dry bulk, again, predominantly on the spot market, and the markets were quite weak. So we earned an average of $7,200 a day, which was a drop, 30% plus drop from the numbers of Q1 FY20, which was close to $11,000 a day. Coming to revenue visibility and coverage, we don't necessarily go out to do a lot of time charter unless we get good rates. But still, we have managed to lock in about close to 30% of our capacity of the remaining 9 months of the year. This is from 1st July to 31st March on the shipping side. On the offshore front, we have locked in a very large part of our capacity. So we have revenue visibility of almost 1,000 crores between the two companies, and this is on a TCY basis. Again, the absolute numbers don't necessarily make much of a difference. What you need to see is what is the extent of cover that we have. We are happy to operate predominantly on the spot market. We are happy to go into a largely time chartered regime as well, depending on the rates that we get. The fleet profile, all of you are aware of, we run 46 ships, of which 33 are tankers and 13 are bulk carriers. And we run 23 offshore assets, of which 19 are vessels of different kinds, PSVs, ROVSVs, AHTSVs, and MPSSVs. And we run 4 jackup rigs. One data point again on the debt repayment schedule. This is something that we plan, and that's why we're putting it in front of you. Our intention, and those of you who have seen us for some time know that we had a large repayment hump in FY20, which was in excess of $150 million. We went through that without any issues. But we are now trying to ensure that we don't face a large repayment amount in any year, and therefore we plan out our repayments, our borrowings in such a way that our repayments are not more than $80 million in any year. And this is the repayment schedule over the next 5 years. Our debt currently stands at about $553 million equivalent, and we have an effective all-in US dollar cost of debt of less than 4% on this, and 85% of the debt portfolio is on a fixed rate, has already been fixed, so is not exposed to floating LIBOR. Coming to what happened in the markets over the last quarter. Let's look at the impact of COVID-19, and this is how we have felt the impact. Others may have felt it differently. So apart from the trade, we are only looking at the operational disruptions here. So we have an issue in dry docking because you can't send, one is the yards were not quite available for the dry docking. They themselves had for some time closed down and the manpower is not available to do dry docks. After that recovered, there are still travel restrictions and the inability and quarantines and the inability to send supervision from the office for dry docks. And we have tried to get around this by doing remote supervision. There's a problem in crew changes, and this is a global problem because of the travel restrictions and people not wanting outsiders to come in or transit through their countries. It's been a huge problem doing crew changes. After the partial lifting of the lockdown in towards the end of May, we managed to do a few crew changes. We managed about 500 crew moves by the first half of July, and we are making significant progress there, though it's a significantly higher cost than we would have otherwise paid. But we are focused on ensuring that the people get home and they are replaced by fresh crew. Lastly, sale and purchase transactions. Because of all these travel restrictions, it was almost impossible to do any sale and purchase transaction or execute any sale and purchase transaction during the last 3 to 4 months, and therefore there was no real chance of doing any transaction. Coming to the supply side, and this is something that we have dealt with at length over the last few quarters, and let's look at some data. Across the board for the 4 main sectors that we operate in, whether it's crude tankers, product tankers, dry bulk, or LPG carriers, we are sitting with very low order books. And you can see those graphs. The crude tanker order book sits at 8%. The product tanker order book is at 6%. The dry bulk order book is at 7%. And LPG at 11%. In this, only LPG is actually higher than, marginally higher than the lowest point in the last 20 years, and still around that only. And this gives a little bit of confidence because the overhang of future supply is not there. And this has been a problem in the past. And if you see the historical average and you look at what it was in 2008-9, you can see that the order books for tankers were in excess of 40%. And for dry bulk was actually at 80%, which is unbelievable when you look back now. Going to scrapping, we've seen quite low scrapping, whether it's for, again, scrapping was not really possible in the lockdown era. But even without that, the scrapping over the last 5 to 6 years has been very low. If you look at crude tankers, we've had only about 10% scrapping for crude tankers. Product tankers have seen only about 6% scrapping between 2014 and 2019. Dry bulk has had a little more, but still only 13% scrapping in these years. And what this has led to is a building up of what we call scrapping candidates. And let's look at that now. we've taken an arbitrary cutoff of 15 years, but this is when vessels start to get a little vulnerable to very poor markets. So look at the red bars. This is the fleet, proportion of the fleet which is more than 20 years old and is the most vulnerable to weak markets, where they have difficulty finding employment and therefore become prime candidates for scrapping. So you have about 4 to 5% of product tankers, crude tankers, and dry bulk carriers, all at above 20 years of age, and therefore forming a potential scrapping pool. Above 15 years, you have almost 20% of the crude tanker fleet, which could potentially face some pressure if you have weak freight markets. Similarly for product tankers, though not so much for dry bulk, because the big building boom in dry bulk started around 2005 and went all the way up to 2011. So that aging of the fleet will happen a little later for dry bulk. So this may form a little bit of a safety net, where if the markets go down to very low levels, you could have some removal and therefore bring the market back into a little bit of balance. As we have said in the past, there are only two permanent things in the shipping supply. One is new ships which are built, and the other is ships which are scrapped. On both fronts, we seem to have a reasonably good picture with a low order book and a fairly large scrapping pool. The story of the last quarter for tankers was the Oil Contango, which was widely reported, and which caused the floating storage play. And let's look at what that was like. And this is on an inverted curve, which is the 3 months forward price of Brent versus the spot versus the front month price. And you saw the Contango peaking in March, April, till the agreement was reached with OPEC, between OPEC and the other large oil producers. And that Contango has come down to near zero now. And after being at $8 plus for 3 months, it's come back to near zero now. Therefore, the Contango economics.
ज्या व्यक्तीशी बोलत आहात त्यांनी तुमच्या कॉलला होल्डवर
and therefore, the economics of the Contango have disappeared completely, of the storage play have disappeared completely, resulting in ships coming out of storage. Again, they've not come back to zero. So you'll see that about on average since middle of last year, and this is probably a function of the IMO 2020 transition, quite a few crude tankers were dedicated to storage. So more than 2% of the fleet was in storage since mid-2019. And that really took off in March, went up all the way to 10%, and now it's come down to about 7.5%. So still a lot of capacity tied up in floating storage, which could come back and cause a further oversupply of ships in the short term. On the product tankers side, we saw the storage peaking at just under 9%. That's dropped off much quicker and is now standing at about 5%. Coming to the demand side, a couple of graphs just to show how dramatic it's been. And so here you have the crude oil demand change, which happened and in April, and that's where we had the real impact, right? So we had 12 million barrels per day drop in demand, and this is estimated by industry reports. People give numbers up to 20, but let's take it as 12 million for this purpose. This is sort of a consensus. At the same time, we had an increase in supply by 1.2 million barrels a day, which meant that you had a huge surplus building up, which was probably at least 400 million barrels of surplus, which went into storage in the month of April. And that's what caused the huge contango. We had the cut in production, which took effect in May, which saw the crude oil production drop by almost 9 million barrels per day. The supply dropped by about 9 million barrels a day. And further drop in supply to almost 11 million barrels a day in June. And that's what has made the market weaker. Coming to the demand for products, and you can see the big green column, which is jet fuel. And logically, it's obvious from what we know about what's happening to jet transportation that it's come nowhere near what it was before. So it still stays at minus 60% versus a year ago. On the other hand, you can see gasoline, which went down to minus 30%, is now down to minus 13% in the month of June. Similarly for diesel and naphtha, etc. Coming to the dry bulk market, this is just a breakup of what constitutes dry bulk, and iron ore is the big one, and followed by, so coal, between steam coal and coking coal, also constitute about a quarter of all iron ore demand. So let's look at a couple of indicators. One is world steel production. Steel production in the first half of CY20, Jan to June, China stayed in positive territory with a small positive growth in steel production. However, world steel production actually dropped off and had negative growth during the half year. And that obviously affected the dry bulk markets. We had a very poor 6 months for the dry bulk market. Now let's look at the other indicator and probably why the market was so weak for the last few months. And you have the Brazilian iron ore exports. As you know, this is the longest haul trade. Basically, it is Brazil to Far East, and therefore the longest haul, and ties up more ships than any other trade on a per voyage basis. And that production had dropped off very significantly, or the exports had dropped off very significantly between end of 2019 and between February and May 2020. And therefore, we saw very poor rates for dry bulk in this period. Starting June, we have seen much better exports out of Brazil, which is probably what has led the recovery in the dry bulk rates. We've seen capes go back to the $20,000 plus mark in this $20,000 plus mark in the spot rates in the spot market. Coming to Greatship, which is our oilfield services subsidiary. We've already seen the fleet count, and we've seen the extent of coverage. The good news is, despite or facing this terrible market, they have a lot of coverage, at least for this year. But let's go and see what's been happening in this market. Offshore Enp spending, which is the primary driver of demand for our assets, has dropped from 295 billion down to 113 billion in calendar 2019. That's a 60% drop, and you can see that in the results of all the oilfield services companies and the distress which is there in the oilfield services business. Adding to the problems, a lot of oil companies have reacted to the pandemic and the drop in oil demand by announcing cuts of between 20 to 30% further in E&P spend. So taking it below $100 billion, which is a level not seen since maybe the very early 2000s. We are already at levels below the 2005 E&P spending level. Obviously, this is reflected in what's happening in the markets, and some regions have witnessed early terminations, renegotiations of rates. Again, this is an update on the market. We're not talking about our situation. Charter rates have come under pressure. There has been some scrapping of rigs, etc., but still there is a significant oversupply. Global fleet utilization is estimated at between 60 to 70% for jack-up rigs, and this is down from the mid-70s that we saw last year, at around the turn of this year, at which point we thought that the recovery was underway, but it's been cut short by the pandemic and the impacts. Vessels have global fleet utilization for vessel is probably at 50% or lower. Now coming to slippage, again, because of the market situation having been the way it is, vessels and rigs which are under construction at the yards have not been getting delivered anywhere near their expected rate or the contracted rate. So it's probably at 80 to 90% slippage. So if at the start of 2019, you had 100 vessels to be delivered, you expected 100 to be delivered, less than 20 of them have been actually delivered in calendar 2019. Similarly for rigs, less than half of the rigs which were expected for delivery have been delivered. This is something that we put up and have discussed in the past. The age profile of the offshore assets, again, this is the global fleet, not our fleet. Our fleet of assets are much younger than these, especially on the rigs. If you look at the bottom of that table, the number of rigs which is more than 30 years old as a percentage of the fleet is almost 40%. These rigs, just as we described some of the crude tankers as being vulnerable, these rigs are vulnerable and may have to be removed at some point in time. Similarly, there is about 20% of the PSV and AHTSV fleet which is more than 20 years old and therefore is vulnerable and therefore could have to be removed or may not come back into the market at all, effectively removing that as a source of supply or competition. So this is one small bright spot in the offshore business. The other bright spot for the offshore business is that the debt repayment profile. So the net debt for the offshore business stands at about $80 million. The net bank debt for the offshore business stands at about $80 million. The repayment schedule is for the next 2 years is only about $23 million each. That's for the next 9 months and for the 12 months following that. And it slowly ramps up to $97 million in FY25. Against this, we have close to $140 million in cash. We also have significant contract coverage for the offshore fleet. Now, let's look at a little bit of the history. I mentioned earlier that the last 5 years have been terrible for the offshore oilfield services business. And let's look at how Greatship has dealt with this. The cash on the balance sheet was at about $118 million in March 2015. 5 years later, it was at $138 million. Gross bank debt in March 15 was $555 million. In March 20, it was $225 million. The net bank debt to equity was 0.75 and now it is at 0.22. Greatship has moved into defensive and consolidation mode, paying down debt and preparing for the bad market. It was also helped by a lot of contract coverage, our conservative approach to the business, where we knew that we were taking a lot of leverage. So we went out and as far as possible, we got 3 and 5 year contracts for our rigs and for the vessels where we could. And that's why we are still standing here and still on a very sound footing, even in the midst of all the distress in the business. Now, coming to some key valuation considerations, and we've spoken about these before, but let's look at them in a more formal way. Those of you who have been following us know that we did a lot of capex in FY17, FY18, and a little bit more in FY19. And therefore, we went up on the net debt to, we borrowed a lot, we used a lot of our cash. We went up quite a bit on our leverage, which is, we measure in 2 ways, net debt to market value of the fleet and also on net debt to equity. We went up from being at 0.2, less than 0.2 to going up to close to 0.5 on a net debt to equity. And that's come down now to 0.25 on a net debt to equity and a little lower than that on a net debt to market value of the fleet. This is again a function of the timing. We levered up when the prices were cheap and now we are paying off debt. We haven't sold too many of the assets that we bought. most of this debt reduction has happened from operating cash flows. And remember that it's not just debt reduction which has happened. We have been paying dividends. We have undertaken a smallish buyback as well last year. So a lot of cash has been generated from these investments. We made $400 million worth of investments in that period, all of which has delivered a very solid IRR, close to 15%. And that's what has enabled us to do, to bring down again the net debt. The second valuation metric, and since we discuss net asset value every quarter, this is what has been happening to our consolidated NAV. We went up to over 500 in FY14. It came down very significantly, largely because of what happened to offshore asset values. We came down to around 400 rupees a share. It's been built up in the last 3 years from 400 rupees a share to excess of 500 rupees a share. And the standalone NAV, which was down to probably below 300, has gone up to 450 rupees a share. In the midst of all this, our stock price trades at a very low 0.4 net price to NAV. And that's something that I thought we should highlight to you. Finally, an interesting slide which we thought, market cap versus consolidated cash and equivalents. The blue bar is our market cap, and this is the market cap. And the previous slide also, the stock price is the price as of 30th of June, which is not very different from today's price. It was at about 210 rupees a share at that time. So not even a 10% difference from there. And so the market cap was standing at little over 3,000 crores. Our cash and equivalent stands at just under 4,000 crores as of 30th of June. To summarize, the market positives for shipping, historically low order book, and potential scrapping. On demand and supply, and you may wonder why we are saying finely balanced when demand for tankers had dropped off 10 million barrels a day, let's say. But remember that dry bulk was at $4,000 a day or $5,000 a day capesizes in April and May, and in July we're making $20,000 a day. So that shows that the market is more finely balanced than we think, and therefore these markets can turn very quickly. The LPG market itself, which was at $10,000 a day spot in second half of June 2020, is now trading in the $40,000 plus range. The market negative for shipping is certainly on the commodity demand uncertainty. We don't know how the world economy is going to recover from this pandemic, how long the pandemic itself will last, and what impact it will have on commodity demand. So that's a market negative. On the offshore side, E&P spends having been reduced significantly, and there being so much negative growth in demand is a big concern. So that's a negative. And we also spoke about the age of the fleet and requirement for removal of a large part of the fleet, which could be a positive. Overall on the company, the positives are a deleveraged balance sheet, proven ability to manage shipping cycles, which I think we proved quite well from FY17 onwards when we bought dry bulk ships, when the dry bulk market hit a multi-decade low. We bought crude tankers, LPG ships at the low points in the market. And as I mentioned, we've made very solid returns on those investments. And finally, capital available. As a result of the deleveraging, capital is now available for future buying opportunities. That brings me to the end of my presentation. I'll now hand over to Mr. Bharat Sheth for some final comments before we throw the floor open for Q&A. Mr. Sheth.
Thank you, Shiv Kumar. And to all my listeners, I hope all of you are well under these very challenging circumstances. Just a very quick thing on what is it that we as an organization have been focused on in the last few years. And when I say last few, let's just call it 3 to 4 years. One is capital allocation. And in other words, when is a good time to buy? When is a good time to sell? when is a good time to go long freight, when is a good time to trade in the spot market. And on capital allocation, I'm really happy with the results that we have seen since FY17. So since then, we have acquired 16 assets and we have sold 2 assets. And our target return on anything that we buy over the next 3 to 5 years, we have internally set a target of somewhere to get a dollarized return on unlevered capital of somewhere between 12 to 15%. I'm happy to state that on all our 16 assets, we have successfully achieved that, of course, albeit on a mark-to-market basis as of 30th June valuations. We sold 2 assets, and the way we track the 2 assets also that we sell, we look at whether were we better off holding to that asset, were we better off selling that asset. And even on the 2 assets that we sold, we were clearly better off selling the asset when we did sell the asset. So currently our track record has been 100 positive, 0 negative. So that's a job well done. On the second big focus area has been operational excellence. And I'm really happy here. This is the one that satisfies me at a personal level a great deal. We have achieved an uptime across the 46 ships at 99.5%. It's possibly the best performance since the company's inception. Equally gratifying is that we have done it with a cost saving of approximately 50 crores. It's a little over 50 crores actually. So here again, I would say that, it's a job well done. Of course, this has only been for the last 12 months. The first quarter continues to show a strong operational performance. We have achieved an uptime on the ships of 99.4%, and I hope that we can continue with this because this itself means multiple $1 million of annual savings. The third area is on the way we now manage the cash. There are always competing demands on cash. And the way we have prioritized it is we must always have sufficient cash on what we call risk capital, i.e. we must have an extended runway due to the volatility of our business. And that extended runway should never compel us to take poor quality decisions. So that's one very important thing. It must give us plenty of operational freedom. And as Shiv Kumar just mentioned, the worst thing you can do is in very poor markets, start shorting freight. And we have unfortunately done this in the past. We wanted to get away from that in the future. And I'm happy to state now that we have the luxury of actually running all 46 ships, if we so choose, on the spot market, even in very, very poor freight structures. So that's a big positive. We will now only go short freight when we think, and again, we are not calling markets because we don't believe we have the capability of calling markets. So that's a big recognition internally within the organization. But we will only short markets in future now when we see strong double-digit dollarized returns on book value. And that's a big change from the way we've run the business in the past. So I believe that this superior way of capital allocation, significant enhancement on operational performance, sitting on plentiful of cash that allows us to ride bad markets, invest in bad markets, because that's when you really should be leveraging the balance sheet. Having the luxury of running all 46 ships spot, however bad the market is, will stand us in very good stead in the years to come. Our focus also now is on the way we manage the interest rate structure on fixed and floating, and also the rupee dollar asset liability mismatch at times. So that's going to be another focus area, and we hope to be able to report to you success in that area as well. Just a few opening comments on our focus areas, and I'm happy now to take any questions. I guess if there's anything to do with numbers and finances, we'll request the CFO to answer that, and I'm happy to come in whenever you people feel it's important to hear from me.
Thank you very much, sir. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on your touchtone phone now. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, in the interest of time and fairness to all participants, please restrict questions to 3 per participant. If you still have more questions, please join the queue afresh. We have a first question from the line of Jeet Gala from Centra Advisors. Please go ahead.
Thank you, CFO sir, for such an elaborate presentation, and thank you, Bharat sir, for giving us an opportunity to talk to us, because I've been an investor in the company for more than 2 years now, and this is the first time I'm getting to talk to you. So my first question is basically on the supply side. So since we've seen in the presentation that the order book is at decadal lows, plus we know since 2008, a lot of shipyards have basically been shut, and not all of the shipyards are going to come back very easily. So looking at these two matrices, that is number of ships which are going to come in versus the number of ships which are going to die, how is this equation looking like considering IMO 2030? Okay, so do you think whenever the market really improve, a lot of supply will easily come back? Say, for example, in 2023 or 2024 onward, because the life of a ship is 15 years, and we don't know exactly what will happen in 2030 norms. So how does overall setup really look like? I mean, so 2004 to 2008 was a demand-led rally. So do you think whenever the next upcycle come, how long it will really sustain? And what is your preference? I mean, would you like a demand-led upcycle, or would you like a supply-led upcycle? So how does the entire setup really look like?
Yeah. All right. If I can answer that, obviously you've asked multiple questions in that one sentence. So let me just quickly summarize it. First of all, the asset life of various ships, different kinds of ships, is not 15 years, but ranges from 20 years up to 30 years. So gas carriers in particular have the longest life. Now your question was, yes, shipyards have, number of shipyards globally have shut down, and that has very clearly reduced the possible new supply that can come in the market. I don't think that is going to change, because many shipyards, I believe, are permanently impaired. And, if you were to ask me, I just think that's just a bad space to be in, shipbuilding itself. So and of course, we are also seeing consolidation in Japan, shipbuilding-wise, in Japan, in South Korea, and in China. I think more and more of these dominant nations in shipbuilding have recognized that shipbuilding is really a bad space to be in. Okay. So from a supply side, if you ask me, I don't believe that we are going to get a big concern coming from that part of the equation. Okay. Now let us look at demand. Demand is impossible to predict, and as I said earlier in my talk, we ourselves have recognized the futility of trying to predict what's going to happen. All that we know is, and we've seen this multiple times, that this is an industry that is much more dependent on events rather than on the supply-demand of demand for commodities and supply of ships. So we have seen years in which supply has been significantly higher than demand, and yet you've had rates go up from 50% to 300% within weeks. So why does it happen? At the end of the day, right, it's all about a few extra cargoes that are available, and there are very few ships in a particular position. In our business, positioning of a ship is much more important than the headline news of supply demand. So you could have an area of this world, some ocean, some part of the world, where the number of cargoes available happens to be more than the number of ships available. And the moment that happens, this market can go up multiple hundred points, right?
Okay.
So ours is an event-based. And I'll give you an example right now. So we have, at the moment, congestion in China, both for dry bulk. We've got a ship there which has now been waiting for, I think, in excess of 30 days. And we are also discharging a cargo of crude oil in China, where also we have waited for close to 20-25 days. Now there is a lot of congestion that has built up. What does that congestion do? It sucks out large chunks of ships from the market. And the moment that suck takes place, you suddenly find freight markets rally. Or you can get hit, the famous Katrina. What happened when Katrina hit the area where you had a significant part in America? You will recollect what happened when a lot of the refining capacity got impaired for a few months because of flooding, etc. And you saw that market went up 5-6 times. Right. So, ours is a event-based industry, and that is one of the reasons why it is so difficult to track, and why after 72 years of being in this business, I would be the first to tell you that these are markets which are really impossible to read. And it's a waste of time trying to even read these markets. It's really a waste of time.
Okay.
And I can now share with all of you that we started this year believing in Q1 the crude market will earn 14,000 a day, and we ended up earning 40,000 a day. So there's no point predicting these things any further. Okay. So the way we want to be positioned, right, is we must benefit. And we've got to learn to play the volatility. That's, to me, amongst the most important things we can do. And if we can play the volatility, i.e. benefit from strong markets and equally benefit from weak markets, that will eventually lead to much, much better results in future.
Okay. Understood, sir. And sir, we have a cash flow statement. So if we, try to map a ship flow statement saying that, what are the expected number of inflows of new ships coming in over the next 3 years versus what are the expected scrappage which is expected to happen. So do you see any significant mismatch which is going to happen, or it's very difficult to predict that too in any of the years?
Well, the one thing that you do know, and not 3 years, because shipyards today are probably full until end of calendar 21. So there is still spare capacity for 22. And ours is a very fragmented industry. There are multiple ship owners. What different people want to do with their cash is up to them. So for us sitting here to forecast what lots of people will do with their cash is impossible, right? But what we can tell you is, even assuming that every shipyard slot in the world gets committed into different asset classes, because some owners are building container ships, some are building LNG ships, some are building chemical tankers, some are building cruise ships, so on and so forth. So it's very, very difficult to get a real fix on it. What we can say, and as the CFO had highlighted, there is potentially a lot of ships which are waiting to be scrapped, right? Now, partly the scrapping has got pushed back because of the current pandemic situation, and partly because we had a spurt in the market. So just take Great Eastern, for example. We had 2 20-year-old tankers, which we had, if you had asked me 12 months ago, what is Great Eastern's plan on these 2 ships, we would have said to scrap it, right? Because they are coming to the end of their life. The moment the market bounced, and we had strong earnings, what did we do? We extended the life of these assets. Right? So we can squeeze out another 12, 18 months. We can't squeeze out another 10 years, but you can squeeze out another 12. And basically, it's a free equity option, right?
Correct.
So, I likened it when I spoke to the board yesterday. I said I likened it almost to a 20-over match. You know how it is, right? Where you don't know who wins it till the very last ball is bowled. And that's what happens in our business. Till the ship is scrapped, you don't know what that last day of equity value will give to you.
Okay.
So that's how we treat all this.
Right. All right, sir.
So basically, by keeping earning days as long as you possibly can, you're building free equity options.
Okay.
Yeah.
Okay. In fact, could you give us some light on what is IMO 2030 all about, and how is it, significantly going to stop the new additions which are going to come in, the ship additions?
Well, I can't say that it will. You see, 2030 is a long way off, right? Okay. And basically, I think the way the world has headed is everybody is getting more and more conscious on environment and sustainability and, emission controls, etc. Right? So what will be the new, and I'll tell you, let me just add one more point to your issue on supply. I think currently very few people know what is the best kind of asset to build because of ever-changing technology. So there is talk about, hydrogen, there is talk about LNG, there is talk about, dual fuel. Some people are talking about some very high-powered cell technology. The question is, can you get to like a EV, electric vehicle, could you get to electric ships, which are then battery run? Right. So the whole propulsion system, right, is under huge debate. And obviously, when you're building an asset for 20 and 30 years, the last thing you want is to get the technology wrong. And this could be a reason why people are holding back, from placing orders for ships. Now, if people do hold back from placing orders for ships, I think, obviously it's good for the industry in that, it's good from the sense that supply overhang is not going to be as much as we have seen it in certain years.
Right, correct.
Yeah, but I mean, these things don't really trouble us. And they used to trouble us at one point of time, now they don't.
Okay.
Because we've just positioned ourselves to benefit every which way. Good markets, bad markets,
right.
We should be able to exploit the situation.
So what has been your overall experience? I mean, a demand-led boom is better than, or a supply-led boom is better?
So the first thing is no boom is good for any commoditized industry.
Right.
Because more money is lost in booms than in busts.
True. Right?
So we don't like a secular boom. We got caught in it ourselves in the boom market of 2003-08. We made multiple mistakes. We don't wish to repeat those mistakes. You've got to be very, very disciplined in strong markets, as I think that famous statement that when the music is on, you can't be on the sidelines. You've got to join the party. And, as night follows days, things like this can happen again and you lose every bit of discipline. So I'm a great believer that eventually you need the volatility rather than a secular bull market.
Understood, sir.
Yeah.
So my last question.
I'm sorry to interrupt, Mr. Kala. Please come back in the question queue.
Okay, I'll come back in the queue.
Thank you. We have next question from the line of Chintan Sheth from Samiksha Capital. Please go ahead.
Yes, thanks for the opportunity and good to hear you, sir, on the call. My question pertains to the point you made that we have the cash available right now with low leverage, and the market is you already explained in detail that market is looking positive. Are we looking at any acquisition of new ships in the coming 3 to 5 years, at least in the near term 3 years?
So I can only really comment on the rest of this year. So currently we are not, because whilst values have come down, as the CFO said, by approximately 7% as an average, we would like to see cheaper price points. And I'll explain to you why. So as I've said, events like this pandemic can happen again, right? It's not even, we haven't even overcome the current pandemic. The question is, you keep getting these black swan events. We saw it at the time of the Lehman crisis, and this is sort of the second big black swan event we are seeing within a decade, 10 to 12 years.
Yes.
Right? And we just want to be positioned whereby if we buy assets, they've just got to be so cheap that we can ride very comfortably through these kind of black swan events. And until we get to those price points, we are happy to, sit on the cash, or we can think of what else to do with the cash. There's always restructuring of capital as an alternative. There is, dividends. There are multiple uses of the cash, right? It just does not have to be steel.
True. And secondly, if I look at, historical quarterly or annual numbers in terms of TCI debt rates, I tried to calculate EBITDA rate for past, decade or so. And in each time our cash profit used to be lowest point I got was around $5,000 a day EBITDA we have been able to generate in a weakest of the market. That is what in the downside we can expect, or this quarter we did around 17,000 order, 18,000 order EBITDA, core EBITDA per day in USD terms. I'm just trying to understand.
Again, I have, honestly, I've never done this calculation. So offhand, I don't think I can answer it. But what I can say to you is, we've always, even in very bad markets, we've always earned a depreciation, right? And Great Eastern's depreciation, and the CFO can step in if I'm making a mistake, but I think it's in the region of 550 odd crores per annum.
About 450
right?
crores.
So that's about 30 to 40 rupees a share.
Yeah.
And we've always earned that depreciation, at least. And whilst, to me, the way I look at depreciation, right, it's really just an accounting charge. And if, let's say, we were not governed by these multiple accounting rules, what depreciation do you provide when the volatility is so great that a ship that you build, and we've actually experienced this, a ship that we have bought, 15 years ago, and the ship, and we sold it at the same price at what we had bought 15 years ago. Now, when you get a situation like this, right, all you do is claw back your depreciation as profit on sale. That's all that happens. So to, really speaking, none of us know the actual depreciation of the asset until it is scrapped.
True. And any plans for any of the ships going into exiting our fleet right now at this stage?
Not now, but I think next year we will come across at least one ship by memory that will be the end of the life. But as I repeat, if you had asked me this question last year, I would have said 2 ships. And so if the market suddenly bounces and we get back to a contango, who knows, right? Can crude oil get back into a contango? Of course it can.
Sure.
Who knows?
Thanks.
Yeah.
Thanks for the answer. Thank you. I will jump back. Thank you.
Thank you. Ladies and gentlemen, in the interest of time and fairness to all participants, please restrict questions to 2 per participant. We have next question from the line of Vaibhav Bajatia from HNI Investments. Please go ahead.
Opportunity. And I must thank you for the fact that you provided normalized numbers also in this presentation. So on the normalized numbers, when I look at ROC, obviously I'm not looking at, current quarter ROC, but just as a benchmark now, would you say that this current quarter ROC or normalized numbers is, we should look at the, Indian comparable returns and judge it accordingly, right? This is the right way to look at it now, right?
Sorry, Shiv, do you want to take that? I couldn't.
Yeah, we had a discussion about this in the last quarter call.
Yeah.
If I'm not mistaken. So yes, you should take it based on the normalized number. But also remember that a large part of our return comes from the capital change in the capital value of the asset. So ideally, we should look at it on an NAV basis over a longer period of time. But yes, cash and the ROC on a normalized basis is certainly a better indicator of our performance than the ROC on a reported basis.
Got it. So, but it must be compared with the Indian government bond yield. If somebody want to look at that, what returns you are.
What comparable you take, I don't know what comparables should be taken, but for judging us, our results on normalized basis are better, are more indicative than the results on a reported basis. That's all that's all I can say.
Got it. And lastly, in the initial remarks made by Mr. Bharat, I do not understand the description provided, shorting of the freight markets. Can you elaborate more on that?
Certainly I will. I said, So, when we have a ship, any ship, right? You have an option of either trading the vessel, what we call in the immediate spot market, means run it for the next 20, 30, 40 days, depending on the trade. You have an option of, and then you come up for repricing, right? After 30 or 40 days. The other option you have is to say, I think the next 3 to 4 months, the market is going to be very bad. So why don't I fix the ship for the next 4 months? That's another option you can play. Another option you can say is, I don't want to take the risk of, ups and downs every day of my life. I've got a weak heart. So let me fix my ship for the next 1 or 2 years. Right? Or you can say, I've got a bank that's breathing down my neck. I want to fix my ship for the next 5 years. Right? And so you have these multiple options. Now, every time when I say fix, so if you fix your ship for 2 years, effectively you've gone short of the market. Yeah? Because you have sold freight for 2 years. So let's say that had we sold freight a year ago for 1 year, we would have missed the big rise in the market that we witnessed in April and May. Right? We would have clearly missed it because we wouldn't have had the ships. So if you are trading spot, right, that's what we are saying. Effectively you are saying, I don't want to take a position beyond 20, 30 days. I don't know what the markets are going to do. And therefore I'll stay long of the market. Means you're long freight because you've kept your options running every 20, 30 days. Right? And because our markets can turn so quickly, and I think as the CFO said, we had an LPG market on the 27th of June earning $10,000 a day. On the 27th of July, that ship is earning $40,000 a day. Right? Now, if you just think about it, on a 40-day business, your delta is $30,000. On a 40-day business, that's an extra 1.2 million, 10 crores of rupees cash to your bottom line. Right? And it quickly builds up. When you have 5 of these things, you've got 50 crores, so on and so forth. So you've got to really be careful on when you want to, go short, i.e. go and cover your ship for 1 year or 6 months or 2 years. And then you just say, okay, now I've got fixed income and I'm not going to play the volatility. Or you say, I've got the balance sheet strength where I'll take the good and the bad, but my eventual average of the good and the bad will be better than if I were to lock in today for 2 years. And these are difficult calls to take, right? And as I said, this is what we want to get better and better at.
Got it.
Yeah.
And that's it from my side. I will come back in the question.
Thank you.
Thank you, sir. We have next question from the line of Bhavin Gandhi from B&K Securities. Please go ahead.
Thank you for taking my question, and thank you for the elaborate presentation as well. So my first question is relating to the offshore business. And obviously, if I look at the NAV and if I look at the book values, there seems to be an impairment on the offshore fleet. So are we thinking about taking an impairment on this, because this has been a drag on our overall ROC profile for the company? Or is there any other way we can restructure the balance sheet on the offshore side?
Well, I mean, first of all, we follow certain accounting principles, which is being adopted by accepted by the board, accepted by the auditors, which determine impairment, right? And looking at that, that's when we take long-term averages, and then we do a discounted cash flow statement, and we come up with an implied value. Looking at that, at this stage, there is no need to take an impairment. And let me tell you the story of impairments. So we in the past have impaired assets, which have then suddenly bounced in value. Now, we never revalue, right? We never revalue up.
Sure.
So when you impair, and I can tell you, we've seen, even in the offshore business, and this has happened to us, our own rig multiple years ago went from $2 million to $40 million.
Sure.
Right? So I think you've got to have a consistent policy on impairment, not look at quarterly or annual fluctuations, and then just say that this is the formula that we will use. If we need to impair, of course we will impair. And it's not that, but we don't want to make it a unilateral decision, because as I just said, we don't know what tomorrow is going to bring. And one thing I do believe this, right? I could be in the minority view, mine could be the only view. But I think eventually years of underinvestment that you will see by these upstream companies eventually means you will see the price of oil going up. Now, when that is going to happen, I can't say.
Sure.
And we've seen offshore markets remain challenged for 10, 12 years. And then, whenever they have turned, because of years of underinvestment, they've gone up 6, 7, 8, 10 times. So imagine if you've impaired an asset, right? And then you're not going to revalue that asset. What have you achieved?
Got it. Sure. So in which case, how do we think about the offshore business as such? I mean, given the way you've described, you've been harnessing your skills to ride out the volatility and actually use it to your advantage. You don't get to play this in the offshore market. So how are you thinking about, offshore as a business going ahead? Whether would you want to deploy more at some point in time?
So I think the way we are looking at offshore currently is that we would like to deleverage, although it is already deleveraged, as the CFO presented in one of the slides. The net leverage in offshore is not much more than shipping, right? But what we have found in the difference now that we really granulated this at a philosophical level, shipping gives us lots more optionality to go long short, right? And as I just explained to the previous questioner, we can fix for 10 days, we can fix for 30 days, we can fix 1 year, we can fix 5 years, and you can do all kinds of things. Offshore, your options are very limited, right? Plus, it is a much more geographically concentrated business. So you can't just move freely from one geographical location to another geographical location like you can in shipping. And when we look at, the net result, so if I played volatility well in offshore, right, there's no way for me to short that market. So let's say that I said, okay, this is a high point of the cycle, we want to go short. We can't go short. In shipping, we can. So shipping, we can really massage the transaction in multiple ways. And therefore, I guess, we are focused on really building our skills to play that game better than we had in the past.
Got it.
That's where all our energies are going now. Yeah.
Sure. And just one final thing from my side. You Shiv sir mentioned about the discount to NAV that we've seen. And given that we've been traditionally we have been very choosy about the kind of assets that you want to buy, can we look at a larger buyback? I know you have an embargo right now, but can the buyback size be much larger than it is today, let's say if the prices remain here?
Well, so first of all, this is something that we cannot consider till end of this year because I think our window doesn't open up until then. There are all these SEBI rules, etc. Right? And under the current set of rules, I don't think we can look at it till the end of this calendar year. At that point, we would always also look at what is happening to steel because eventually we are a shipping company, right? And obviously, if we can get cheap assets, right? I mean, cheaper, when I say asset, meaning steel. If I can get cheap steel, that will always be my priority number one, right? But if I can't get cheap steel and I find my underlying, if the paper is a much cheaper way to acquire more of that same steel, then paper will always be an option, right? So again, and you must remember that unfortunately, again, because our rules are so very bad, here you don't have freedom. You don't have freedom on buybacks. You have restrictive. You have huge leakages on taxation because of buybacks. You have all these price points you have to determine on buybacks. If you do a buyback, I guess you can't immediately raise capital. There are just too many restrictions. So we've always got to be very careful. Hello?
Thank you, sir. We have next question from the line of Saloni Hemnani from India SME Investments. Please go ahead.
Hello, sir. Thank you for taking up my question. My first question is, sir, regarding the scrapping part. You mentioned that the ship asset values have been coming down and the age of the vessels above 15 years as a percentage of fleet is really high. But there hasn't been a significant increase in scrapping. So any specific reason for that, apart from the reason that happened because of the COVID in the March quarter?
Yeah, so two things. One is many scrapyards globally shut down because of labor problems. And also when you go to a shipyard, you must remember you've got to get your people off the ship. And because of travel restrictions, nobody could get off the ship. So April, May, and June, we saw very, very poor scrapping. That was one reason. The second is, of course, particularly for the tankers, we saw a huge bounce in tankers, right? Both on the clean side as well as on the dirty side. So it means crude oil and petroleum products. And again, if you could even squeeze in one extra voyage of 30, 40 days, you made just lots of cash. And therefore you deferred your decision to scrap that ship, right? Unless the ship had no fading life left in her. So everyone who could defer scrapping a ship in certain asset classes, particularly tankers and gas ships, they chose that option to defer the decision. So I think it's a combination of scrapyards not having the labor, ship owners not having the ability to get their people off the ship before it reaches the scrapyard, and the way the markets behave. So three things all interplaying.
Right. Okay. Thank you, sir. And my second question is, I actually missed the numbers of the time charter rates of July that were mentioned earlier. Could you please repeat that?
Can I request the CFO to send it to you? Is that just easier?
Yeah, I think we should do that separately. Yeah.
Yeah. I'll get the CFO is on the call, so we'll have it sent to you.
Okay. Thank you so much.
Thank you. We have next question from the line of Vikram Suryavanshi from Phillip Capital. Please go ahead.
Yeah. Thank you very much for having this opportunity to interact. Sir, one is that cash as a risk capital for us. So what are major considerations that maintaining the high level of cash as a risk capital while deciding that? And second question is about if you look at in 2007, I think prior to earlier cycle, we ordered 3 VLCCs, but post that we never had exposure to VLCC market. And while listening to you, the way we are developing our skills for shorting the market or having a one position and really benefiting from the volatility, how is our thought process for VLCC market? So these are my 2 questions.
Yeah. So I'll answer the one. Your first question was what?
Cash as a risk capital. So what are the major considerations?
So what, as I said, the way we look at the cash, obviously for the period that it lies in a bank, it doesn't do much for us. But so long as it increases the purchasing power of that cash, we look at that as an effective return. So let's say my dollars currently are earning me about 0.5%, right, in terms of cash.
Okay.
Currently, we're earning 0.5% on the cash. But let's say that the ship's values, as the CFO said, has come down 7%. Now, any asset that I were to buy now as compared to 3 months ago is now 7% cheaper. So I've effectively increased my purchasing power, right, by 7%.
Right.
So in that sense, cash has earned me the 0.5% in the bank and my purchasing power has gone up by 7%. Now, let's say if ship's values were to come down another 7%, then my purchasing power has gone up by 15%. So that's the value of cash. The second thing is we want, as I said, other than this, risk capital is just to ensure that we always have cash, whatever happens, to debt service, to meet all our debt obligations. That to us is all about, reputation of the organization, and that is obviously cannot be compromised. The third thing that cash enables us to do is, to say that, look, we have 46 ships. We are under no pressure to go and fix the asset for any fixed income business unless we think that's the right thing to do. And it gives us so much operational flexibility. And in a business like ours, where one day you can be earning 1,000, and then you can be earning 5,000, and then you can be earning 500, having that level of cash just gives us lots of comfort that we will never be put in a corner where we are taking suboptimal decisions.
Got it, sir.
Yeah. So for us, that is really, really important.
Is there any reference, like overall asset size, how much percentage broadly should be cash, or it is just based on 3 parameters, what you have also discussed?
Well, so obviously until we find a right opportunity and, if we have to build up cash, we will. We haven't set any internal targets. Once we are above this level of cash, if we build up more cash, we build up more cash. What we don't wish to do is build up the cash and then misallocate it in terms of capital. It has unfortunately happened to us in the past. We just don't want to repeat those mistakes again.
Yeah, and really acknowledge for that discipline for us.
Yeah, I think, if you look at this organization over the, hopefully for the multiple decades ahead of us, this will really stand us in good stead.
Right. Yeah, and for my second question on VLCC market.
Yes, sorry. So on the VLCC, if the question is, would we look at acquiring VLCCs? The answer is yes. It's the most volatile of all asset classes. in the tanker segment, and if we saw the right opportunity, absolutely we will get into that sector. We missed it, which was our fault. We had a lovely opportunity to acquire some BLCCs in 17. Had we done it, we would have made a lot more money, but that's life. You miss some and you get some.
Yeah, thank you very much, and it was a pleasure interacting with you, sir.
Thank you.
Thank you, sir. We have next question from the line of Nidhi Chawla from SBI Mutual Fund. Please go ahead.
Yeah, hi. Thank you so much for answering the question, sir. So, and most of the questions you've answered. I just wanted to understand, when we were looking from FY16 to 18, if I look at your decisions to acquire the assets and where the rates and the asset values were, and when I look at it today, and I know you've answered in many other questions, I would still want to understand, if you really, I know it's a very difficult situation right now to assess, but still if you have some pecking order in terms of the new investment that you would be looking, and the sectors that are looking much more lucrative to you given where the order books stand, where the overall cycle you look at, and how are you looking at those various sectors? If you would be able to summarize, that would be really helpful, Mr. Bharat. And so I'll come back.
Yeah. So I'd love to help you in any which way I can. So let me first tell you that we are very agnostic to which sector we invest in, right?
Right.
So whether, if we got an opportunity in dry bulk first, we would look at that. If we got an opportunity in gas first, we would look at that. If we got an opportunity in crude, we'd look at that, so on and so forth. But we will focus on the 4 sectors where we have currently built up significant skill sets: crude oil, petroleum products, LPG, and dry bulk. These are the 4. We are not going to, at this stage, think of going to a 5th, right? Because we really want to be the best there is in the world in these 4 sectors, right?
Sure.
Now, so within these 4 sectors, we are agnostic. But having said that, we have kept internal caps so that we don't place a 100-0 bet. Even though we believe that we are improving on the way we handle the volatility, we would never place a 100-0 bet on any one of these 4 sectors. So we've kept internal caps that however bullish we are in a particular sector, we will not have more than X $100 million exposed to that particular sector. So we'll never take a 0-1 bet. Right? Because something can happen and things can still go wrong. There's no guarantee in life on anything. Right?
Right.
So we will be responsible in the way we do it, but within those caps, we are completely agnostic. But yes, if we are getting better at volatility, and I hope we will eventually get much better than we have been in the past, we will prefer to buy more of the assets which have a much greater volatility in the market.
Right. So that will be, so then it is more to the previous question what you answered, that will be on the crude and the product side.
Well, there's volatility as much on the gas. I just explained to one of the previous speakers.
Right. Sure.
The LPG market was 10,000 on the 27th of June and 40,000 today. That's huge. And can go back to 10,000 tomorrow. I don't know.
Sir, actually, I was more so also trying to understand and trying to pick up your brains, because that time when you were talking, even in the Concall in your meetings, you were basically we used to talk about the rates being low and, even though the rates are low, the values were coming down. I know the understanding of the values today is not very clear. I was just looking at in terms of the situation in the current market. Is any particular segment looking lucrative today to you, or is it, nothing is clear as of now?
No, it is very clear. What is very clear is that we would not be buyers today of any asset class.
Got it, sir. Got it. Okay.
And especially, look at it, right? If my paper is trading at 50 cents on steel, what am I better off doing if you were in my position?
No, sir. That the point is always taken, and I've had a very long discussion with Mr. Shiv recently on a con call, and I would actually come back to that question, and most of the people have asked you this. But on the cash level, sir, I'm not saying, you're completely right in terms of how you manage the business. Pardon me if I'm wrong in this assessment, but even in the last, buying cycle that we did, we spent around 1,900 to 2,000 crores over 16 to 18. When the cycle was actually, if I look at order books today, the shipping cycle position today, in whatever way, it looks like that opportunity is not visible today, where we are, sitting on the asset levels, the prices, but we are sitting at double the cash levels that we have. So do you really think that we need so much conservatism and in terms of, the capital protection in this kind of environment? And secondly, would we have such kind of quantum of opportunity available for us to deploy such cash?
Okay, so let me answer that. Whilst the cash that is reflected on the balance sheet sounds like a lot, it's really not that much, right? And I'll explain to you why. So the risk capital is capital we don't touch. So that cash is out of bounds, right? That's to just make sure that as a company, we honor every single commitment with all our lenders. So that's correct. You've got to strip out all that cash, right?
Sure. Yeah.
Yeah. Then thereafter, the cash that we sit on, what we call investable surplus, that's possibly in the region of 200, maybe if we stretch ourselves, maybe 225, $250 million. So that's whatever that mathematics is in rupees, 17, 18, 1900 crores, right?
Sure.
Now, so the question is, will we get to the same price points we got in 16 and 17, right? It's something today I cannot answer. I don't think anyone in this world can answer. Right. But if we get to those price points, would we be able to deploy the money? Absolutely, we'll be able to deploy that capital, right? But would we be, saying, okay, forget some discipline now, let's go and invest at a higher price because we are getting very anxious or we are sitting on too much cash? I don't want that discipline broken. Because it's very tempting when actually one of the most difficult things in life is sitting on the cash and not doing much with it.
Yeah,
it's not easy to sit and earn 0.5%. But trust me that this will stand us in very good stead for years and years to come, so long as we are disciplined.
Sure. No, so I agree with that, but it's just that even the cash flow generation is expected to remain strong, right? And the leverage that we have today on the books, we would have more ammunition to play actually over the next 2 years. Well,
I hope we do. I hope we do. The more the cash we build up, I promise you that we will put it in good use. And what do I define as good use? Whenever we invest in steel, i.e. in ships, we should be in a position to generate hell or high water somewhere between 12 to 15% dollar returns on unlevered capital. And if we can do that on unlevered capital, right, that would be a job really well done.
Right. So I think it's just a question that whether you would want dividend to...
Ma'am, I'm sorry to interrupt. Would you like to come back in the question queue?
Thank you so much. Yeah. Thank you so much for the answer, sir. Thank you.
Thank you. Ladies and gentlemen, please restrict questions to 2 per participant. We have next question from the line of Anuj Sharma from M3 Investments. Please go ahead.
Sir, thank you for the comments. I had a question based on the narrative you have given. Now, I think we have gone long freight and we have played the strategy assuming volatility will remain, and I think volatility has played out. But how do we capture the intense peaks which we saw? So is there a way we can refine further wherein we can get closer to peaks, or it will always remain a random event that we were there at the right place, right time we got it, or we can refine it further?
So I think that's a very good question. I don't know if we'll ever get the peaks. For peaks, you need luck, right? And just like when you hit a trough, you get into bad luck. So it is never our intention to get to the peak or to hit peaks, because that depends on luck. What we just want to get good at is, so long as we can consistently capture 80-90% of the peaks, I think we would have done a very good job, right? And that's where we are focusing our energies on. We have a little team that's really working hard on trying to see how best can we get, how can we get better and better at this. And I am confident that, it's much more difficult, of course, than capital allocation. And capital allocation, I think, our track record over the last 4 years speaks for itself. As I said at the beginning, 18 right, 0 wrong, right? So that's a great record to have. Now, on the day-to-day volatility, it is much, much more difficult. Having the right ship at the right time is going to be important. But having said that, what you also need is having multiple asset classes in the same category of assets. So then you can spread around. You have some ships in the Persian Gulf, you have some ships in the East, you have some ships in the Atlantic, Mediterranean, so on and so forth. So whilst everything may not benefit, maybe you will capture X percentage of that benefit. So I think it's a combination of luck, it's a combination of having the fleet size, and of course a combination of our internal skills. And, I'm not saying we won't make mistakes, right? So we will make some mistakes.
Right. And sir, my second question is, you have clearly explained your discipline and wanting to buy assets cheaper. But, let's suppose the charts which you have put up show that, there could be a trend which is the other way around. Clearly it has not moved the way. But let's suppose there's an uptrend, for a long time. Would you be willing to participate on the way up? And clearly, let's suppose it's not a volatile trend, but let's suppose a directional move up. Would you want to give up the discipline and possibly purchase some on the way up? Just your thought.
If you ask me personally, the answer is no.
Okay.
We've got caught in this in the past. We have bought assets because, the temptation is, so let me just quickly tell you this. You've got money lying in the bank at 0.5%. On the way up, you suddenly get dollar yields at 20, 30, 40%. And there is huge temptation to buy on the way up because, you can immediately boost your bottom line, etc. But as night follows days, this will end up in grief. And we don't want to end up in grief for sure, ever again.
All right. And sir, my third question is, there would be assets which would be bought as a portfolio, so company is willing to sell. And I know you have a very strict evaluation of ships for buying. So, if there is a portfolio of a company wherein you are not able to evaluate the quality, but that's available at a very, very lucrative price versus buying a la carte ships, at a reasonable valuation, but quality is, ensured as per your parameters. Would you ever look at buying companies with a portfolio?
So let me tell you, we did that whilst we didn't buy any company, of course. We have bought ships from very good stables without even seeing the ships. And we've bought it in blocks. So if the question is, would we do that again if it came from a great stable? And there are some people who keep their assets incredibly well. Although I believe now Great Eastern keeps its ships. We probably run now the best ships in the world. And I'm not exaggerating that. Whenever you have time, come and have a look at some of these ships. But yes, the answer is we would be happy to buy in block. But would we be looking at buying companies? I don't think so. And the reason is because there's always a challenge on cultural fit. And, we want to preserve our culture to the best we can.
All right, sir. I'll come back in the queue. Thank you, sir.
Thank you.
Thank you. We have next question from the line of N. Samrat from Dwarka Wealth Managers. Please go ahead.
Yes, sir. Good evening, Mr. Seth. Thank you for taking my questions. Just three small ones. At the end of March, the dollar versus the rupee was at the end, last Friday of that quarter, 75.58. So I just wanted to have a quick answer. This particular quarter, till what dollar price were you hedged, sir?
Sorry, can I request the CFO to answer that?
Okay, sir.
Yes, I'll take that. I don't understand what you meant by till what price are you hedged?
Yes.
You have a natural hedge.
Yeah, natural hedge. I mean, basically, let's say that was 75.58. So till what particular level would you be hedged? I mean, taking the algorithms into question.
No, we don't have any such thing. So we have very, very minimal hedging that we do because we have a natural hedge. Okay, we have dollar liabilities and we have dollar assets. And whatever is extra, we just keep it in dollars because our next purchase utilization of the money will also be for buying dollar assets.
So, Mr. Shiv, I just wanted to say 75.58. So from there you would be, say, hedged for, say, 1 or 2 rupees from there on? Something like that you have?
No. So as the CFO mentioned, we have very little forward sales on our dollar balances. Sometimes we will do it. As I said right at the start, this is another focus area. We really want to get better and better at currency management. Because, we always have this challenge, right? How much do you keep in dollars? How much you keep in rupees? So on and so forth. But we don't want to speculate. So this is out of bounds for speculation.
No, sir. I was, okay, that's one thing. And I was talking about that, the dollar loans, sir. The dollar loan part. So
our dollar loans, even on the liability cover, because as the CFO very rightly pointed out, we have a natural hedge. Only in extreme cases would we cover our dollar liability by buying forward dollars.
Okay.
Yeah, but normally we would not. But once in a while, because again, look, we want to focus on shipping. That's our core business. That's what we are spending our energies on, trying to specialize in. And if we just get those calls, continuously right. I think that should stand everybody in very good stead.
And so just back of the envelope calculation, what would be a cash break-even point for tankers and bulkers, sir? Just approximately per day, dollars per day?
Yeah. So again, everything hinges on what you define as cash break-even. But, if you just take as an average...
minus the depreciation, that's all.
No, so I'll just keep... again, because we have corporate debt, then we just do an internal allocation on assets, right? Because when you do a bond, you're not necessarily taking the bond raised on a particular asset. So you raise an X amount of money, you switch it into dollars, and then you buy multiple assets. And then we do an internal allocation. So we just treat everything as, just take whatever is your interest liability and just spread it at random.
Okay, so what would be the tankers and the bulkers cash break-even points running the costs per day, dollar cost per day?
Yeah, so I guess, again, I don't have an offhand answer, but I guess somewhere, I don't know, Shiv, do you have an offhand?
Yeah.
I don't want to speculate on a number I'm not very familiar with.
Okay.
So just to tell you, if you're looking for the operating costs are for the entire fleet is between $4,000 and $6,000 a day.
Okay.
Depending on the type of ship. That's a cash operating cost.
Say for tankers, approximately, sir?
For tankers, it will be in the higher region, somewhere in the 5,000 to 6,000, depending on the ship.
I think so. If you look at the crude tankers, maybe it will be closer to 6.5 to 7. If you look at the smaller tankers, I guess it would be in the 5.5, somewhere in that region.
So, and adding the G&A, then how much we would be, sir? Adding the G&A, then what would be the cost?
I think our G&A is currently running at $1,200 a day, Shiv, maybe $1,300.
Something like that. Yeah, something in that region.
Of course, in the pandemic time, it will reduce, right, the G&A, because we're all working from home.
Okay, and so for bulkers?
I'm sorry to interrupt, would you like to come back to the question queue?
Yeah. One thing, just on the bulkers,
sir. Bulkers is about 4.5.
About 4.5.
Yeah.
And sir, how much? What is the TC for the tanker, sir? So last quarter of June. What
that's in the presentation, which is on the website.
In the presentation.
So and currently, sir, are we getting the TC?
There is nothing like currently because it changes by the hour.
Approximately, sir, for Aframax.
Hello.
Hello, how much are we getting for Aframaxes and Suezmaxes?
I would say at an average somewhere between 16 and 18.
Between 16 and 18. And for bulkers, sir?
Because
the case
is the one we have. That one we have fixed at 20,000. We've already fixed it.
And for the
till December 2020.
Come back in the question queue.
Sorry.
Thank you, sir. Thank you, sir. We have next question from the line of Himanshu Upadhyay from PGIM India. Please go ahead.
Yeah. Hi. Good evening. So my question was more on this side. See, to the question what you replied to Anuj. Okay. So last cycle, if we look at, we did participate in the up move. Means okay. Even so, the way I am looking at it is the fleet was around 29 in 2003. It moved to 41 in 2006 and 46 in 2008. So if we see a similar longer term cycle, means how would you place your bets, and would you participate in the up move, or means
no? Somebody just asked me that question, and I said, first of all, I hope that although it's a very odd thing to say for any ship owner, as I said, I hope it's not a secular bull market, because that would really challenge us a great deal on our discipline. But if it happened, we'll have to think on what to do with the cash that we'd obviously generate, right? As I said, to us, what would stand us in good stead over multiple years is the volatility. Anything secular in nature is not so good.
Okay. And one question was on the equity investments last year, what we did in Great Eastern Chartering LLC, the Sharjah. Is the buying of equity shares would be a regular feature in that company? Or how is it, means what's our thoughts currently, and what are the risks we are taking in that book? Means last year, I think it was...
really we leave it to that company to take all the decisions. Obviously, it comes more as information to us. That company, all I can say is, what their strategies is really depend on, and they have a very independent board there. That company has got $25 million in cash. I mean, so far, they haven't done anything stupid. They've also, got a 100-0 positive track record. So we wish them well. But if the question is Great Eastern going to capitalize it and fund any of their losses, God forbid they made any, the answer is no, we would not. They've got to live within their means.
Okay. And one last question on the Great Ship. We have said that the crude prices have been low, and low investment is happening in the offshore side, which will lead to a classical upcycle which happens in this type of...
Sorry, there's an echo coming through. You might have to switch something off. Or do I don't know. I'm getting an echo.
Yeah. Am I audible now?
Yes, perfect. Thank you.
Yeah. So the question was on Great Ship. In the annual report of Great Ship, we have stated that low crude prices will lead to low investments, and which will lead to recovery in offshore, and we can have a classical upcycle in that segment. Till now, we have stated that we don't want to put money there much more. But once the clarity of the cycle is there on the offshore side, the asset prices would have also risen. Would we be comfortable to buy at a higher rates once the clarity is there in Great Ship or the offshore side? How are we looking at those things? The way
if the market, so the basic thing is, each company must learn to live off their own, right? And if the offshore market does well and that company is able to generate surplus cash and meet their own investment philosophy, so be it. We are not going to sort of say that, all right, offshore is now going to, values are very cheap and therefore they're all going to go up, etc. We just said we can't take these market calls, right? So we have set internal discipline to make sure that, all right, It can't be on a gut, okay, this is cheap. That is something that we are trying to strip out, because eventually nobody knows what's cheap.
But on the shipping side, we are ready to take such a call.
No, because it's not on a gut. We've institutionalized the entire process now.
So in great ship or the offshore side, how far away from that phase of procedurizing?
No, but as I said, in ship, the difference is, those assets also are obviously at multi-year lows, right, in offshore. Now, there the problem only is one, which is that you can't long short. That's a business where you can only go long. So, then it becomes a one-way bet.
But that means that whenever
It's got the same volatility. It's got the same volatility as shipping. In fact, it could be even more vicious. But you can't, what's the right word? You can't create multiple options on how you play the volatility, which you can in shipping. So in shipping, for example, in a bad market, I can just say that I will commit my asset only for 10 days or 15 days. In offshore, you can't do that. So in a bad market, you get compelled to commit your asset for multiple years, because that's much more of a tender-driven business. There's really not a spot market there.
Okay.
Yeah.
So what would be the philosophy for that company? I mean, when we have stated that that company would have a separate philosophy.
Yeah. So that company also, currently the priority is to just keep paying down leverage through cash flow. And as, someday hopefully they'll become debt free, and then they will take certain risks that they think fit. Obviously, we keep exchanging notes and we spend a lot of managerial time thinking about all these issues. But, we've just seen that shipping has this ability to place so many more options than offshore. And that's what we like.
Okay. Thank you from my side. Yeah.
Thank you.
Thank you, sir. We have next question from the line of Raja Kumar, individual investor. Please go ahead.
Hello.
Please go ahead.
Hello, good evening. Yeah, can you hear me?
Good evening.
Yes, loud and clear.
Yeah. Good evening, Mr. Bharat and Mr. Shivap, and thanks for for the detailed presentation and comments. Sir, if you permit me, just give me like 2 minutes. First of all, I want to thank the entire crew and the employees of G Shipping. While we all sit at home and stay away from this virus, so I think the crew and the employees of G Shipping have done a very commendable job in delivering stupendous results. I would like to first thank for that. Sir, I have a couple of questions. So first one is on the strategic reason to have an offshore division, because I just want to know globally, is there a practice or shipping company having the exposure to offshore? Because I have not come across any major company with this kind of an exposure. So just wanted to know, why, what are the strategic reasons to have an offshore? And just to, labor on that point again, as Shiv mentioned that, the market cap, the cash and so on and so forth, you're saying that, we are not getting the right market capitalization. So there I just want to know, maybe the market is perceiving that the offshore is going to drag the cash, the longer run. So that could be one of the reasons why we are not getting the right kind of market cap. And further, I want to know what steps the management is taking. I know we cannot do buyback till end of the calendar year, but I just want to know what is the way, other ways of, improving the sentiment, or, what are the other steps taken? Because, just one more point. I went through the AGM notes for this year. I saw that almost 10% of the shareholders have defended the appointment of all the key directors. So just want to know, are there any rivalry group or are there any set of investors, where they are not in line with the management I hope if you can give some color on that. So that is my first question. And the second one is on the TCY numbers that is given out. It would be helpful if you could give the shipping revenue by the category, both for the quarter gone by and as well as for the revenue visibility that you are giving. If you can also give what is the TCY, for each of these categories. So that will at least give some color from an investor perspective, in terms of understanding how the future P&L would look like. So these are the
So your first question was on offshore. So there are multiple shipping groups that run a shipping company and run offshore businesses, right? The difference is that they don't necessarily run it through a subsidiary, but they do run it as two separate businesses, but within the same group. So it's not as if what we have done is unique. That's number one. Number two, your question was, why did we do the offshore? So you will recollect that in 7 and 8, when we obviously were generating lots of cash at that time, and we had prior experience in this sector, and it was a time when the business was providing very, very strong returns. So again, we were getting dollar yields of 30, 40, 50%. And if you see in the first, 5 years of the life of Great Ship, they had some incredibly strong returns on invested capital. And it was a time when, shipping was not doing so well, and therefore it was the offshore subsidiary that helped us on a consolidated reported number that, the parent company was also able to report stronger numbers. So it's not as if all its life it's been a bad business. I mean, it's just now, the current phase is obviously not so good. It had started improving, as the CFO alluded to, about a year ago, and then we got hit by this second black swan event. We first got hit by the first black swan event. We couldn't have anticipated that. And then, the second black swan event. So we've had to survive these two most unexpected outcomes. But we've built up, I would say, great operational skills in the meantime. And, one thing all of you must remember is that there are very, very few global oil and gas service businesses that are doing as well as Great Ship. I can't think of a single one. And I'm happy if any of you can identify one other offshore company globally that is doing better than Great Ship. So that's that. Now, what was your second question?
So my
about some rivalry with whom?
No, I saw almost 10% of the shareholders have descended the director's appointment. So just wanted to
know what? 10% have done what?
Yeah. They have not approved the appointment. If you see
Well, I mean, people have a right, to either approve or disapprove. It's like, I guess, an election in a country, right? Not everybody approves of the same ruling party, and not everybody disapproves. So people have a freedom of choice, and people are free to either say good job or not a good job. So we are quite relaxed about these things.
Yeah, I completely understand that. Sir, I think G management is, synonymous to Infosys to an IT, right? Yeah. So that is how I view this company.
So just coming back on that offshore question of yours and how there's a fear about it being a drag, let's look at it dispassionately, right? So we mentioned that Great Eastern Shipping itself has an investment in the offshore business, which is on our books, which works out to 110 to 120 rupees. Okay? That's on our books at 120 rupees per share. The second thing is the offshore business has net debt of $80 million, which I mentioned. Okay, that $80 million works out to 600 crores as of today, which is 40 rupees a share. Both those put together are 160 rupees per share. Okay, if if the offshore business is entirely written off, which means the assets are worthless, including the contracts. Okay? If all of it is worth zero, Great Eastern Shipping value of the NAV drops by 160 rupees per share. Okay? This is assuming everything is worthless. 4 jack-up rigs built between 2009 and 2015 are worthless. 19 supply vessels built between 2015 are worthless. Assuming that, our NAV still comes to 300 rupees per share. Okay, just to put it in perspective, because when we talk of this drag on the results, we have to put it in context. What is this drag on the results? And when you put it at
Hello?
on that 300 rupees per share. Okay, so we need to put that also in perspective. Look at the strength of the shipping business. Look at the strength of the management of shipping business as it stands. Take the worst case for the offshore business and then see whether this valuation, fear is overblown or it's being priced too much into the stock. I'm not giving you advice on the stock, but because you mentioned that this might be a overhanging fear, I thought we should mention what the numbers are like, just to put them in perspective.
Yeah, but Shiv, this discount to the actual value, because the shipping, the ships are as good as the cash. It's really perplexing that why the market is giving such a kind of a discount. We are getting a market cap which is worse than a holding company discount.
So what we'll have to do actually for that, to get a handle on that, is to have a reverse conference call where we can ask questions and the people who do the valuations can answer the questions. But that's a discussion for a different day. So let's focus now on Great Eastern Shipping and what's happening with Great Eastern Shipping. Thank you for the question, which
yes, you could please answer the question on TCY as well, Shiv.
Okay, the TCY, we don't like giving it out on a very specific category basis, and we think that it's enough to do it on the sector-wise, which is crude LPG.
But Shiv, please understand this information is too little for an investor to understand how it's going to.
Okay.
Kind of
some of this information.
At least the revenue visibility, whatever you have clocked in, that you could give.
Okay.
That is something which you have already clocked.
Right? Can I come in?
Yeah, please.
It doesn't take a rocket scientist for any investor to understand that you've got a market cap less than cash. Now, what more information?
Sorry, Shiv, I didn't get the last one.
That is Mr. Shah talking. Yeah.
I said it doesn't. Hello?
Yeah, can you?
Oh,
Hello?
There's a big echo. Hello?
Yeah.
Can you hear me?
Yeah, I can hear you, sir.
Yeah, I said, you said, all right, if we gave further breakup, it helps an investor, right?
Yeah.
Yeah, but in what way? Because, look at it this way. No investor is a rocket scientist who needs to understand that you've got a company that's valued less than cash.
Mm-hmm.
How is it going to help anyone else?
Thank you, sir. We move to the next question from the line of Vaibhav Bhajatia from HNI Investments. Please go ahead.
I'm providing the follow-up. Looking at your presentation, you can choose to answer it separately, but can you help me bridge the gross debt number between the normalized numbers that you have calculated and the reported number? There's some 750 crore gap.
Yeah, sure.
Sorry, what exactly was it? On the debt?
On gross debt number, if I see normalized gross debt
so let me
and the reported debt.
Yeah, correct. Let me just give you an example, and from this you can extrapolate. So we borrowed 2,000 crores. Okay. It was swapped into dollar debt. $300 million of dollar debt, very approximately. Okay? Fine? So on that $300 million of dollar debt today at 75 rupees, let's call it, is 2,250 crores. Correct? 75 rupees into $300 million is 2,250 crores. You're with me so far?
Yes.
On our books, this debt shows as 2,000 crores. Okay? But our effective debt, which, which unfortunately the standards say that 2,000 crores is a debt and the remaining is mark to market and therefore a current liability. Our effective debt is 2,250 crores in this example. Therefore, we, in the normalized, we take the debt as 2,250 crores. Similarly for other transactions as well. Okay.
Right.
So that bit is clear, right?
Yeah, that bit is clear. But actually, in essence, if you look at, you have already because you swapped that thing, your effective liability is still the same. I mean,
it's 2,250. No, it's 2,250 crores. In dollar terms, it's the same, but in rupee terms, it's 2,250 crores. Let's take it that way. If we had to pay it off today, it's 2,250 crores, and that's why. That is why normalized. So to show the clearer picture. So we are not just taking the normalized impact on our P&L, but also on effectively on the balance sheet.
Okay, got it. I will actually take it separately. No problem. That's it from my side.
Yeah. We are happy to discuss it.
And Shiv, maybe you can explain it offline in more detail.
Yes, that's right. Yeah.
So that the gentleman understands it.
That's right. We'll put up some FAQs on our website also.
Okay.
Thank you very much, sir. Ladies and gentlemen, that was the last question. I'd now like to hand the conference over to the management for closing comments. Over to you, sir.
Would you like to say something?
Well, just to thank all the participants for all the questions. I hope our endeavor always is to explain not only the results of the quarter, because quarterly results have some value but not a great value. Much more important is for you to focus and understand on what we are trying to achieve as a management team, and what are the areas where we want to get better and better, because eventually that is what I believe will reward the shareholders in the longer term. Once again, thank all the participants. Stay safe. That is priority number one. And look forward to interacting with you when we do the quarter 2 results. Thank you.
Thank you very much, sir. Ladies and gentlemen,
if I may, just one thing, and thank you to Raja Kumar for bringing it up. He's absolutely right. Our crew on board our ships are doing a stellar job in difficult circumstances where they haven't been able to go home for quite some time. And we would also like to place on record our thanks and gratitude for the service in keeping the supply lines all over the world open.